You're listening to QSBS Solved, where we share insights for founders and investors looking to maximize their business's growth, exit opportunities, and tax savings. Our team at QSBS-Rollover.com offers specialized services to help you benefit from owning qualified small business stock. Our podcast guests are leaders in their respective fields and work on every side of the startup journey to help founders and investors win. The ideas and opinions shared here are not investment, tax, or legal advice. Reach out and we'd be happy to connect you with a qualified advisor or tax counsel. For now, enjoy today's episode.
Let's talk about what kinds of businesses don't qualify for QSBS, or Qualified Small Business Stock, under Section 1202 of the Tax Code. The law doesn't actually give you a handy list of what does qualify. Instead, it gives you a list of what's excluded. So, if your business falls into one of these excluded categories, the stock won't qualify for that big capital gains tax exclusion, even if it's a small domestic C Corp in every other respect. To qualify for QSBS, you not only have to avoid these excluded business categories, but your company also needs to meet something called the active business requirement for most of the time you hold the stock. While the law doesn't give a hard number, that's generally interpreted as somewhere between 80 to 95% of your holding period. On top of that, at least 80% of the company's assets, by value, have to be used in an actual qualified trade or business. Now, let's dig into which business activities are specifically excluded from QSBS eligibility. These are spelled out in Section 1202E3, and I'll break them down for you. First up, healthcare. If your business is all about providing medical services, think physicians, dentists, nurses, vets, any licensed health professionals, that's excluded. If the activity involves direct patient care, billing Medicare or Medicaid, or services performed by licensed providers, it's not going to be QSBS. That said, companies in the medical device space, lab testing, or biotech might still qualify as long as they're not actually delivering patient care. Next, law. Law firms and legal consultants are out. If your business is about advising clients on legal rights, drafting documents, or representing people in court, that's an excluded business. Then we have engineering and architecture. If your business provides design, technical, or structural services, so consulting engineers, architecture firms, anyone designing buildings or offering technical design, that falls under the excluded category. Accounting and actuarial science are also on the list. This covers firms that focus on bookkeeping, tax prep, auditing, and other financial analysis, especially if the work relies on certifications and you bill by the hour or case. Performing arts is another big one. If you make money from artistic performance, musicians, dancers, actors, entertainers, QSBS is off the table. This applies whether you're a solo performer or you run a company centered around live talent. Let's not forget consulting. This category is a little broad. It applies to businesses whose main revenue comes from selling advice to clients. Now, just because your business gives some advice or interacts with customers doesn't automatically make you a consulting firm for QSBS purposes. But if your primary business is selling expertise and advice rather than an actual product or service, you're probably in this excluded category. Even if you create custom deliverables, if they're essentially just advice dressed up for the client, you're likely still consulting in the IRS's eyes. That said, if you're selling software or hardware and the advice is just a bonus, that's usually not excluded. Athletics is next. If your company's main activity is participating in or organizing athletic competitions, think personal trainers, coaches, or sports teams, that's excluded. The list keeps going. Financial and brokerage services are not QSBS eligible. If you're in the business of investing, advising on investments, managing portfolios, or brokering financial products, like financial advisors, investment bankers, or insurance brokers, these are all out. There's also an exclusion for reputation or skill-based businesses. This is kind of a catch-all. If your company's main asset is the reputation or unique skill of one or more employees, celebrity-driven brands, influencer companies, or businesses built entirely on one person's fame or know-how, you probably won't qualify. But if your company is built on systems, processes, or team expertise, not just one person's reputation, you might still be in the clear. Banking, insurance, financing, leasing, and investing, these are all considered passive or financial businesses, so they're excluded. If your primary activity is managing or lending money, so traditional banks, leasing companies, insurers, investment funds, you're not going to get QSBS treatment. Farming is another category. If your company is in the business of growing crops, raising livestock, or anything agricultural, including tree farming or even trading in raw commodity products like grain, you're not eligible. Even trading unmodified farm commodities can knock you out of QSBS. Natural resources. That's any business focused on extracting or producing oil, gas, or minerals, especially if they get special depletion deductions. This one's pretty straightforward. Hospitality is also excluded. That means hotels, motels, restaurants, bars, cafes. Basically, any business operating lodging or food service facilities are out. Even businesses that are adjacent to these, depending on their structure, could fall into this category. And there are a couple of asset-related pitfalls that can disqualify a business. If more than 10% of your company's assets are non-operating real estate or investments in other companies' stock or securities, unless you own most of the company, you could lose QSBS status. If you're sitting on a pile of cash or investment assets that's more than 20% of your company's value, and that cash isn't earmarked for working capital or R&D, that can also trip you up. One more note, if your business is in the early startup phase or deep into research and development, it might look inactive. But Section 1202 does have exceptions for pre-revenue activities if they're expected to lead to a qualified business. So, the bottom line, Section 1202 isn't about giving you a list of good businesses that qualify. It's about clearly telling you which business activities don't. If your company doesn't fall into any of these excluded categories and you meet all the technical requirements, C Corp, asset thresholds, holding period, you're probably in a great position to take advantage of one of the most generous tax incentives available to founders and investors.
Thanks for listening to this episode of QSBS Solved. We hope to hear from you soon. Remember that the content shared on QSBS Solved is for informational purposes only and should not be construed as legal, tax, or investment advice. While we discuss strategies related to qualified small business stock, or QSBS, including rollover planning, listeners should consult their own tax, legal, and financial advisors before making any decisions. Laws and interpretations can change, individual circumstances do vary.